A very good morning to you. Hi, this is RN Bhaskar from BKBB. That, as you know, is an acronym for Bhaskar Ki Business Baatein. And yes, every Saturday at 8:15 we talk about news behind the news. But every week we also have a podcast that is put up, and a podcast this week is the falling Indian rupee, which we shall talk about just now also as part of this breaking news. And when you look at what's happening in India, there's a lot this week, especially on the Russian front. But let's talk about the news later. Do remember to click the subscribe button. The like button helps us immensely. And please tell all your friends about us. What we are going to talk about is going to be discussed by my co-anchors. There's Katya. Welcome, Katya.
Sure.
There's Janavi. There's Saloni. And there's Hussaina. All of them together will discuss some of the major developments of the past week. Let's begin with the first story, which is there in every paper, and that's about Russia. Janvi, could you come in?
Yes. So India and Russia have just moved to upgrade their economic relationship, signing a 5-year roadmap that aims to push bilateral trade to $100 billion by 2030. So at the center of this roadmap is the simple goal, which is to fix certain points of friction from non-tariff barriers to bottlenecks in logistics to the whole messy world of payment settlements. These are the issues that have held India back. India's exports back for years. So Russia has now agreed to address many of these hurdles, clearing the way for India to ramp up exports, especially in pharma, agriculture, marine products, and textiles. So right now the trade is estimated at around 64 to 65 billion dollars, and most of that is just India importing discounted Russian crude. But for trade to actually to genuinely double, this composition has to change, and that is exactly what the roadmap will try to do. So one of the biggest shifts is in payments. Nearly 2 dozen Russian banks have opened special Rupee Vostro accounts to bypass Western financial systems. But with Russia cut off from SWIFT, which is your Society for Worldwide Interbank Financial Telecommunication, settling payments requires a slow. It remains a slow, costly, and an uncertain affair. But there needs to be like a digital currency solution, or a modern mechanism uh, through which we can achieve this, because Russia might remain India's biggest oil supplier, but it's still not on a serious export market. And then there's connectivity. Like both the countries want to operationalize alternative routes like the international north south transport corridor and the Chennai Vladivostok route. So if these routes truly take off, then they could cut costs and reshape India's access to the Eurasian markets. But these connectivity projects have been in slow motion for years. So the question is whether this new roadmap will finally do something to accelerate them. And Russia has promised uninterrupted supplies of fuels and fertilizers as well, while the two sides are pushing for collaboration in critical minerals also, which is a sector that India wants to de-risk from Chinese dominance. So, and there's also movement in nuclear energy, with discussions on a second Russia-backed plant, and in labor mobility, where new migration agreements could give Indian skilled workers access to Russian markets. So what this roadmap really signals is an increasing interdependence between both the countries. So for Russia, while for Russia, India is a crucial economic partner in an extremely sanctions heavy world. For India, Russia is a reliable energy supplier, especially in these turbulent times. But whether or not it reaches the 100 billion mark will depend on how much of this will translate into reality. So, what is your take on that, sir?
Thank you, Janvi. It's a very, very important development for several reasons. One, India and Russia trade connect ties are likely to zoom, and this is possibly accelerated in the last 2 years because of two developments. One is Trump's sanctions and tariffs and immigration policies. And the second is the defense, the skirmish that took place between Pakistan and India, where India found that the Rafales were not very reliable and the most effective weaponry was the S-400. It's quite possible that India will now start moving more and more towards Russian weaponry than the Western weaponry. And of course, oil is there, and the possibility of trade taking place. And for payments, while no paper talks about it, I suspect it's a new payment mechanism that BRICS has come up with, where you can pay in your own currency through the BRICS exchange, and that remains in a basket, and then it's used for various other things. How it's going to get operationalized, that has to be detailed out, but yes, there is a way. Crucial difficulty will India have the muscle to stand up to the United States threat of further sanctions? And that remains a crucial question. Let's see. Katya, any views on this?
So there's also another interesting answer. Russia's Sir Bank has actually opened a mutual fund which allows them to invest in Nifty 50. So which is a
Absolutely.
great way for Russia to invest in use the rupees that it gains from India, and it's actually good for our Indian markets also because there is foreign money coming in. So it's a very interesting times and interesting moves actually.
Yeah, it's a good move, except it may hype up the mind and markets more. But anyway, it's a good move, yes.
Right, sir.
Let's take the second story, which is equally very important, and that is our PMI falling. Could Saloni, can you come in?
Yes, sir. So India's manufacturing sector has slowed down in November. The Purchasing Managers Index (PMI) fell to 56.6, the lowest in 9 months. In October, it was 59.2. This data comes from a private survey published by Hong Kong Shanghai Banking Corporation and is compiled by S&P Global Data. It is important to note that any number above 50 means this sector is still growing, but the fall from the last month shows that the pace of growth has clearly reduced. The slowdown happened mainly because of US tariffs and also the impact of GST rate cuts is now fading away. The survey said that Indian manufacturers noted a substantial upturn in order book volumes, which they attributed to competitive pricing, positive demand trends, and greater client interest. Inflation rates also receded in November, with input costs and selling charges rising at the slowest rates. Although companies suggested that the trend for international sales remained favorable, reflecting greater sales to clients in Africa, Middle East, uh, there was a mild loss of overall growth momentum. So, on the employment front, if we see, the survey noted that manufacturers in India adjusted their hiring efforts and purchasing activity in line with a slowdown in new order growth. The purchasing activity was at its weakest upturn since February. Regarding outlook, the survey noted that companies remain confident of a rise in output over the course of the coming 12 months. What do you think about this?
Saloni, this was an important item because of two reasons. The PMI fell because the economy is slipping. Consumption has slowed down. The rupee is falling. Trade balance is worsening. And the PMI is the trigger, is a good indicator of what's happening to the Indian economy. Katya, your views?
All of that said, the consumption has not picked up. Whatever picked up after GST also, it might have cleared some of their inventory, but they are not confident enough to order more. So this is something we have to note. So see, GST, while it might have given a push, like passenger vehicles in general, auto has seen very good traction. during the festive period. But that was actually seems to a very short term move. Nobody, no economist has come out and said that this is going to sustain for the coming year, etc. Very little might move in, is what people are saying. And then there is no pent up demand that they expected. So we've seen it in GST collections as well. GST collections fell in November, which exactly shows that the expected volume to make up for the value loss, it didn't make up for it. So it's time to wake up and smell the coffee.
Thanks, Katya. Yes, we enter difficult times, and that's why the next story is a consequence of the earlier story, and that is how GST is slipping. Hussaina, could you talk about it?
Yes, sir. So GST 2.0 rate cuts, which were earlier sir meant to boost compliance and consumption. However, a month later, numbers are showing a very mixed picture. So net GST revenues for November rose just 1.3% year on year to to rupees 1.52 trillion. But again, this number does not include the GST compensation cess, which, let me tell you, is an extra tax charged on luxury and sin goods like tobacco, SUVs, aerated drinks, etc. Now, these taxes are to compensate states for revenue loss after GST was introduced. The cess money is pulled and used to pay back states or repay loans taken during the pandemic for the same purpose. Now, because this cess has shrunk to approximately 69%, the overall GST kitty looks weaker. Apart from this cess, also gross domestic revenue fell 2.3%, which again shows a slump in domestic economic activity. Import revenue rose from 10.2%, which kept total gross revenues afloat. Refunds also dropped slightly, especially for domestic transactions, which I think was down 12%, ending a 2 month spike. Sequentially, the slide is sharper. If we compare these numbers to October, gross revenues fell 9.5%. Net revenues dropped to 6.1%. This means that GST 2.0's first full month saw a clear slowdown. Other economic indicators also flash mixed signals. So, as Saloni talked about, the manufacturing PMI dipped to 56.6%, signaling slower growth. Even rural work demand under Manrega fell 32%, which was the fifth straight month of decline. Industrial output, which is IIP, slumped to a 14-month low. Yet again, consumption did not collapse much because the festive period with GST, Bachat Utsav and policies like that, it boosted the taxable value of supplies by 15% for September, October. So this suggests a Laffer curve response. Lower tax rates pushed companies to comply more and consumers to spend more. Even there were sectors which benefited from rate cuts saw strong growth in taxable value. For example, FMCG sector saw a 17% rise, passenger cars and buses saw a 20% rise, etc. etc. And companies did pass on GST savings to consumers, which again supported the demand. However, so GST 2.0 is nudging consumers and companies toward higher compliance and spending, but at the same time, domestic revenue has slowed, and there is a sharp fall in compensation cess, which makes the fiscal picture looks much more weaker. And economists warn that unless the next few months see stronger collections, the government may fall short of its GST targets. So, what are your insights on this, sir?
Well, thank you, Hussaina. A very good comprehensive overview of what's happening on the GST front. But you must understand GST is slipping for the two reasons. One is a slowdown in the economy, slowdown in purchasing power, consumption, which in turn makes GST collections a little less. The second factor that has caused the GST slip is the government's own inability to raise money, because of which it has not been able to have largesse and grants to states like UP and Bihar. Earlier, for the last few years, it's been huge allocations of funds for building a Mathura, for building the Eastern dedicated freight corridor, etc., etc. And when money is given, that becomes GST, and GST is propped up because of government grants. Now there are fewer government grants, so there's a slowdown on that front, slowdown in the economy. GST is likely to slip even further. But thank you, Susanna. Great story. And now we go to just one question that we have time for. And the question is, Do you think the Indian economy will slip further? Yes, it could. It could, provided, unless, of course, the government decides to improve investor sentiment in the country. The second the RBI reduced the interest rates, you found the rupee slipped even further. When the government has all these raids and seizures by businesses, businesses don't invest in India, they invest overseas. Foreign investors, the portfolio investors don't want to come in when the rupee is weak. And the other investors don't like the economic climate. You change the economic climate, you make sure that investors can come in without any difficulty and are not asked to pay bribes and compliances, etc., etc. You'll find the situation changing. And most important, if you want investments, speeden up your talks with China so that investments come in. India needs investments. The only country that has investable money is China. Europe is on the decline. America is on the decline. There's no money there. And that's why the government has to move quickly. And that takes me to the end of today's session. Have a great day today. And have a great week also. And do remember to come back next Saturday. We look forward to having you once again. Take care. Good luck.